They're in grave danger. I'm your host, Steve Van Metre, and thanks for joining me today. In our lead story today, a new threat is emerging that could topple the regional banks, and this could be the reason by the sudden and unexpected pivot by the Federal Reserve, as perhaps they're looking to starve off the next financial crisis. And as you're about to see, the situation with the regional banks is far worse than even we thought. Now, before we get to that, you may remember on yesterday's show, we talked about how Fidelity was going long the dollar, and I told you I didn't agree with that. I made my case. Well, it looks like the market agrees with me. Here you can see the appetite for the dollar slumps to the lowest since 2020 after the Fed pivot, and this is all due to the fact that the market really actually believes that central bankers control currencies, and so when they start to cut, it ends up devaluing the currency. As demand for options that benefit if the U.S. currency appreciates fell to the lowest in more than 3 years versus those that pay out if the greenback weakens, this according to an index of 1 month risk reversals. Meanwhile, expectations for strength in the yen soared to the highest in 5 months. The reason behind that is simple. People believe that the Bank of Japan is actually going to tighten monetary policy, which would drive up their value of the currency. Of course, against the dollar, since it's tied to it, would put downward pressure on the dollar. Of course, we know that has nothing to do with it. The reality of the situation is the Fed is likely cutting because they either sense something is coming, perhaps they know something's coming even worse, and they're trying to cover it up. And all that means is, of course, that the U.S. economy is going to continue to slow, and that's the real response we're seeing in the dollar. Now let's take a look at what's going on in the Fed, because this all sets up with potentially what's going on with the regional banks. As investors are baffled after Powell turbocharges the slide in U.S. rates, which we can note just 2 weeks before he was saying higher for longer, and perhaps there would be even more rate increases. And then literally 2 weeks later, almost to the day, what we start to hear is, well, there could be one more rate hike if the data turns around, but suddenly his board members all of a sudden are pricing in up to 3 rate cuts next year. And what did we hear from Williams? Of course, the following day said, wait a minute, while we're thinking and even talking about rate cuts a little bit, you shouldn't get too excited. We have none planned for the first quarter of the year. And what did the market respond by saying, no, wait, we think you actually do. And this all comes back to perhaps what's really going on with the banks. As bonds and share prices have surged since Powell on Wednesday let it slip that policymakers have discussed interest rate cuts, a signal that his remarks, whether he meant them or not, have further loosened financial conditions. Now, we're going to challenge that notion here in a minute, because this is one of the most inaccurate beliefs in the market, that lower interest rates, and I want you to understand, even the Federal Reserve believes that lower interest rates loosen financial conditions and that higher interest rates end up tightening. It's indeed the exact opposite of what actually happens. Of course, we're talking about a market not influenced by the Fed, but higher interest rates indicate looser financial conditions. Lower interest rates indicate tighter financial conditions. This is something we learned, of course, from the great Milton Friedman. And that's a risk to the central bank's goal of slowing demand to rein in inflation. Even New York Fed President John Williams, as we mentioned, attempted to pare back market euphoria on Friday by saying it was too early. Discussion mark rate cut fell short of undoing this week's rally. But of course, what we know is the probability that the Fed is going to cut in the first quarter is increasingly high. And here you can see that indeed that lower interest rates lead to tighter financial conditions. As we look at the net percentage of domestic banks tightening standards for commercial industrial loans to firms of all sizes. Now, when we talk about the banking system, they're the ones that are in control of tightening the system. So when they tighten standards and they constrict the credit creation mechanism, well, what you should expect to see is interest rates fall. And why do they start naturally falling no matter how investors are positioned? The answer is really simple, because in a debt-based economy, you need credit creation. So when banks tighten standards and make it more difficult, rates start to fall to get people to borrow money. And sure enough, we see that relationship here in this chart. As banks tighten lending standards, you don't see rates rising in response. You see rates falling. Again, you see that here again during the global financial crisis. Going into the pandemic, of course, you remember that Powell started cutting rates well ahead of that. And now this is one of the first times we've seen rates actually rise, at least in the short term, as investors and hedge funds short the bond market because they believe rates must rise. Well, tight financial conditions are telling us rates indeed must fall. I'm baffled, as the chief investment officer of fixed income at Franklin Templeton said, referring to Powell's post-meeting comments. It's completely unclear why he decided it was necessary to turbocharge the move lower in rates, especially given this previously acknowledged as rates have been rising, the market's role in creating appropriately tighter financial conditions. And this leads to the question, the ultimate question, what does the Fed know? Why are they worried? Because central bankers, if nothing was wrong, we should have heard from Powell, hey, we're staying higher for longer, and there still is a potential another rate hike or more if we see inflation come back. Now, all of a sudden, he and his cohorts were saying, no, we're pricing in the fact that inflation is indeed going to come down, and while there's a possibility it might resurge, we could actually deal with that, and instead, we're starting to price in cuts, and that's a problem because it's telling the market that the Fed knows something that nobody else knows, and maybe the Fed is just hoping if they talk rates down a little bit, the problem will go away. The reality is, if it doesn't go away, we're all going to find out why, and that means rates are coming down in a big way. And while the two-year Treasury, most linked to the outlook for Fed policy, rose to a session high immediately after Williams' comment, the move quickly faded. The yield is now little change on the day, about 4.41%, on course to drop this week by over 30 basis points, and indeed is pricing in completely 3 full cuts next year. And whereas the Fed just said, look, we're projecting that's what we could do. And as I noted in the show the other day, the dot plots that the FOMC puts out are one of the most inaccurate, if not the most inaccurate predictor of where the actual federal funds rate will go. So noting that, the 2-year, as you're seeing in this chart, knows exactly where rates are going. And in fact, the market yield on 2-year Treasury is shown in red against the federal funds rate in blue. And what do you know? Indeed, the 2-year Treasury coming down, and that causes the Fed to reconsider their decision here going into the pandemic, start to cut rates. Perhaps the real reason behind that cut was the 2-year Treasury. Now we're seeing again, this time it's telling the Fed, look, you're going to be making a cut in a big way. And of course, this all leads back to the ultimate question. How do you make money trading the bond market? Because many of you have told me, Steve, I've tried trading, it doesn't work. I've shown you how to use our tools. Let's take a look at this trade, because one of our subscribers said, look, this pays for my research for a whole decade. We keep saying you pay for a year or two. He said, Steve, forget it. It's more than that. Let's take a look at this on November 2nd, our CTA Timer Pro. Now on Sundays, we talk about machine positioning because those are big drivers of the market. Now our report looks at a historical overlay where the machines don't actually do. And when we see these big minus 100% positions, it tells us on historical position, it is at an extreme. And that means you want to look for a reversal. We started seeing that on November 2nd. Now, pairing with that, you want to make sure the technicals, all those momentum indicators like the MACD and the RSI and the STOCH and all those things are moving with it. Well, we got a signal on November 2nd, this through our Momentum Timer Pro report that aggregates all those signals down into something and smooths them out for you. Here you see one daily buy count on the technical signal, and that tells some of our most successful traders everything they need to know to put in a trade. And sure enough, on this green candlestick on November 2nd, you had your reports that morning, you've been waiting for the signal, you would have put a buy on open. Right now, you'd be at 14.4%. Talk about trading for your research, not just for a week or a month or a year. You're talking years, perhaps up to 10 or more, making it that simple. And yes, you too can be successful. I'm so confident that 3 people, if you grab the coupon codes, get a free month of each, get some trades in, you'll find out why like so many others, these reports are the ones to have. But what's Powell really concerned about? Is it the bond market or perhaps something else? As we look to the weekly payroll report in terms of the unemployment claims, we know that initial claims stay relatively low at 202,000. And historically, this is indeed super low. The big concern that maybe he's watching is continued claims here, we know, that have risen now to 1.876 million Americans still on unemployment, which is baffling to the Fed because we know that their job openings and labor turnover survey, they're claiming there's millions of jobs, there's tons of jobs. This shouldn't be an issue. And yet, why are all of these people still on unemployment? They should be getting work. And even worse, that number is continuing to rise, which signals perhaps the reason rates are falling and some other concerns that are about to hit the banks. Here you can see the federal funds rate again alongside the 2-year Treasury yield in red. Now we're overlaying continued claims in green. And here we can see as continued claims tend to rise, what happens? Well, the 2-year yield senses that there's problems in the economy. It starts to come down, dragging the Fed with it. You notice going into the global financial crisis, the same event happened. As continuing claims went up, the 2-year Treasury yield comes crumbling down. Now we're starting to see the initial signs. Everybody started buying into continued claims coming down. We warned you that was not likely the case, and sure enough, the 2-year Treasury yield now is perhaps reacting to where it needs to be in the marketplace, absent what the Fed is doing. The Fed seeing perhaps now the stress of the banks, which we're about to look at. The unemployment claims on a continued basis are continuing to rise. The 2-year Treasury yield is continuing to fall, and while they might not have a clue what is wrong, they're looking at the market and saying, yes, it's telling us that maybe we did too much. Because bank loan volume shrink as deposits rise, but this trouble is brewing, this according to Zero Hedge, as they discover that regional bank shares have been soaring up towards pre-Silicon Valley Bank levels, despite yet another increase to new record high in the usage of the Fed's bank bailout facility, now at $124 billion. So investors are buying into big way to these regional banks. They think everything's a-okay, and as you're about to see, it's not okay. In fact, it's getting dangerously worse. Finally, a key warning sign, as they say, continues to trend ominously lower as small banks' reserve constraints supported above the critical level by the Fed's emergency funds. Well, at least for now, let's take a look deeper in here because the Bank Term Funding Program, this is where a lot of these regional banks went to get money from the Fed. Well, it expires in March. It means they got to pay it off by then. So here's the challenge. Either the program gets renewed or maybe rates are back at zero by then. We'll see. But here's a problem. As small bank cash continues to go away, as perhaps investors chasing higher rates at CDs and other investments pull their money out of these banks, putting pressure on the banks to borrow an increasing amount of money from the Federal Reserve at very high interest rates, knowing they have no way to pay it back in March. This is putting a dangerous situation here because even those security holdings, now you remember, these banks hold treasury securities, mortgage-backed securities, and they're all massively underwater due to the Fed's hiking cycle. Maybe the Fed's hoping if we trim rates or at least talk rates down a little bit, maybe the banks can sell some of these and get some cash and get this situation turned around so we don't have to tell anyone. In fact, maybe in a few months we can say, hey, you know what? We're not talking about rate cuts anymore. We were just nervous about, well, who knows what? It doesn't matter. Or perhaps the banks are about to blow up in a big way and kick off the next financial crisis. As Redline shows, without the Fed's help, the crisis is indeed back. Well, that's because it never actually went away. And the large bank cash needs a home, all of which makes us wonder. As you know, just thinking out loud, are we setting up for another banking crisis in March as the Bank Term Funding Program runs out, as it, well, was only a temporary program to begin with, or the overnight reverse repo drains to zero, which of course will make the case that it is because the Treasury finally decided to actually issue NFT bills, and what we're seeing is money that is coming out of this overnight program at the Fed. What happened here is money market funds didn't have the collateral. They just didn't exist. There wasn't enough in the system. Now there's enough in the system. They're not having to go to the Fed. They're going to the marketplace. This is also putting downward pressure on yields. But the issue with the banks, now that you see they're in big trouble, we've identified that the Fed is starting to panic. There's something going wrong. We know the dollar's starting to weaken, starting to establish that something is wrong with the U.S. economy. Here's the blow that's about to hit. As underwater car loans signal U.S. consumers are slammed by high rates. In November, people with negative equity were underwater by an average of $6,054, the most since April 2020, and well above pre-pandemic averages, making things even worse. It's a precarious spot for many Americans coming after a twin surge in car buying and interest rates that strained finances and fueled an uptick in automotive repossession. So this is a problem because remember, banks are not used car lots. They're not set up to take a bunch of these back. Now, when you lend money, you know, okay, there's a small percentage of people that are going to default, and on their loans, you can manage that. But if you start to have an increasing number, because you imagine going down to the bank trying to get some money out of the ATM and they've got used cars lined up for sale, well, maybe that could happen. And here we see resilient in the face of inflation taming rate hikes. Repossessions have ticked higher, with car owners falling behind on their payments at the highest rate in 30 years. So you're talking about, you hear from these political elites how strong and robust the labor market is, how the U.S. economy is going to engineer that soft landing and surge higher, and yet we have repossessions at a 3-decade high. This is a massive problem for the banks because guess what they're getting these cars back at? Not above their current value, below their current value. They're going to take a loss. So when a bank repossesses something, in an ideal situation, they can sell it and at worst case break even, if not sell it at a profit. In this case, they can take big losses. As the Federal Reserve ponders when to start cutting rates, stress in the car market is a window into the financial struggles of everyday Americans who are having a hard time making ends meet. And sure enough, if we look at delinquency rate on consumer loans, this at all commercial blanks in blue on a year-over-year rate of change against continued claims. And this is a case we've made before. When people go on unemployment, their income goes down. Not only do they have less discretionary money, they have less money to pay on all their debt. And usually what you see at the end of these cycles is we're at new record highs in debts. And sure enough, this time, that doesn't disappoint. We're there. And notably, what are we starting to see? The delinquencies are picking up in a big way, and that means, of course, what we can know is that continued claims are going to surge higher. Here you can look backwards at the global financial crisis, the dot-com bubble. You see the same relationship even going back in the 1990s, and perhaps what the Fed knows that maybe we don't know is that banks are about to post some big numbers in delinquencies. This is going to put a lot of stress on them and cause panics in the market. But meanwhile, everywhere else that there's problems, we still see problems with the banks in China as home prices slump deepens as big cities boost support. Of course, we know the deflation. Look at this. As China new home prices fell for the 6th month in values and the secondary market plunged, the most in 9 years. Again, this is looking like deflation, underscoring why authorities are stepping up efforts to address the property slump. So we have issues in the U.S. banking system. Not only do we have these car loan issues, we have commercial real estate issues that are going to show up early next year, and the small banks are running out of cash. In fact, they're out of cash. It's going the wrong direction. And look at the Chinese banking system. It's only getting worse. As new home prices in 70 cities, excluding state-subsidized housing, dropped a mere 0.37% October when they declined 0.38%. Here we can see the property market slump largely continued in November as more developer defaults further dampened buyer confidence, which is outright shocking because, as you know, I said that would be an issue that keeps people from buying. Pretty obvious. You wouldn't buy something if a company was going insolvent. Of course, developers will likely resort to steeper price cuts. This is deflation to boost sales toward the year end. So the question remains, what does the Fed know that we don't know? But all that matters is the bond market is saying things are bad. And as we showed you, you've got the tools to make a ton of money on that. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.